Good afternoon, and thanks everybody for joining us. My name is Gary Dehart. I'm the publisher of Tax Practice News and Insightful Accountant and host of today's short webinar, Pass-Through Entity State Tax Law Changes. Our speaker is Christine Gervais. Christine, thanks for joining us. And she's a technical editor of Tax Practice News, the CEO of the Department Tax, and a nationally recognized speaker who provides education to other CPAs on how to best serve clients, as well as instruction on a wide variety of topics for business owners on how to maximize success. She prides herself on the value she can bring to clients with her extensive tax knowledge and providing strategic, forward-thinking financial strategies to help clients grow. She has a master's degree in accounting. She's been a CPA for over a decade and is currently pursuing her PhD from Liberty University. I haven't had an update on that lately. How's that going?
It's going. We're keeping me out of trouble. I'm in between classes right now. I have the week off, but the next one starts on Monday, and then I have about a year left. So
a nice breather for the week. So that's nice. All right, a couple of housekeeping items, then we'll turn it over. So CPE is not available. This is just a short 30-minute session. So if you do have any questions, we ask you that you please put them in the questions panel. And the link to the recording of this will be posted to our YouTube channel. I will also put it into the chat panel once I turn this over to Christine. And we will also have the slides that may already be there available. Yep, great. Slides are in the chat for you as well. And then both of these will also be sent in the follow-up email, which you will receive within about 24 hours of this event. So I think that is all my key housekeeping items. So I'm going to turn this over to you, Christine. And again, thank you.
Awesome. Okay. See. Let me share my screen. And I also have the Q&A open as well as the chat. I'm going to put these over here on my other screen. So if you have any questions, comments, concerns, feel free to interrupt as we go. I will do my best to keep my eye on the chat as well as on the Q&A section so that I can answer those as quickly as possible for you. And yes, thank you, Gary. So Gary also just put up the link to the YouTube channel in the chat, and the copy of the slides, this slide presentation, are also in the chat as well. So feel free to go in and grab those. So thank you for being here today. Gary already went through and gave me a great introduction, so I won't continue with that, but my name is Christine Gervais. I have had my CPA license for over a decade. I've had most of my experience be related to small and closely held businesses, and this is one topic that is very specific to that sort of conglomerate of clients for you. So this is going to be information that is super pertinent if this pertains to some of your clients as we start going into tax planning season, as I lovingly like to call it. I know we're all still recovering from an October 17th filing deadline, which was a challenging one for sure. But as we start to trend towards the end of the year, these are some of the tax planning things that you can take into consideration for your business clients who are owners of pass-through entities, or if you're working on the returns for the pass-through entities, this is information that's going to potentially impact how you help them to plan and reduce their tax liability. So as most of us are very familiar with, in 2017, when they passed the Tax Cuts and Jobs Act, we had that limitation to SALT deductions on personal tax returns. So previously, if you were itemizing your deductions, there wasn't a limit to how much an individual could take on Schedule A with their itemized deductions for state and local income taxes that had been paid. The Act passed in 2017 capped that at $10,000 per year. So that cap didn't necessarily impact just maybe someone like me who's paying income taxes or real estate taxes on a more nominal amount of money, but it had a really big impact in some cases where you have pass-through owners that are paying large amounts of state taxes, in some cases across multiple states, due to the nature of their pass-through income from either their S corporation or their partnership. So what has started to happen as a result of this is the resulting piece of this legislation being that there were individuals who all of a sudden were experiencing a cap on their itemized deductions in this scenario, is we have had several states pass legislation that allow for pass-through entities to sort of create this tax loophole, if you will. And I think as accountants, we hear tax loophole and we all get a little uncomfortable, but this is actually being enacted in a various number of states. So 16 passed it in 2021, 6 more have joined in 2022. At the end, I will actually go ahead and post a link in the chat to a website that lists the states that have passed these rules so that you have access to just a clear list of who has and who hasn't. And we'll talk in a little bit about what you can do, some of the tax planning things that you can do if you're working with a client that has to file in a state that has not passed these rules. But essentially what these states did is they passed state legislation that said you can pay the state taxes for your pass-through entity at the entity level. So in other words, instead of simply having normal ordinary income pass through on the K-1 to each of the individual states. So if we just take, for example, an S corporation that might have to file in California and New York, instead of just having that ordinary income pass through to all of the shareholders and then them having to file individually in California and New York, pay those individual state income taxes, and then take a deduction on their personal tax return that will most likely be limited to that $10,000. Those states have passed this pass-through entity tax rule that says this entity can elect to pay those state taxes at the corporate level, at the entity level, partnership in some cases as well. So that means that the entity is allowed to take the deduction for those state taxes paid rather than that deduction passing through to the individual shareholders or the partners and them being potentially limited in the benefit of that deduction on their personal income tax return. So this is a really big deal when you are looking at these scenarios of those potential limitations. If you have a pass-through entity that does have a significant state tax income in one of these states, this is an opportunity to offer some really valuable planning services to clients that are potentially affected by this. So what clients are a good fit so that you can go through your client base and you can start to figure out, who might be impacted by this and who can I have a conversation with to provide them some added value in terms of our services. So you're looking for a couple different things and you can start in a couple different places. You can look at individuals where you prepared a personal return last year who may be meeting that SALT cap on their personal return. So any individual who's paying more in state and local income taxes than they're allowed to take as a deduction on Schedule A. Not all of them are obviously going to be pass-through owners in every single case. You could simply have an individual that is just being capped, but that's a great place to start, is to kind of generate that list of, hey, who's experiencing this cap and might be able to benefit from some more planning to see if we can help them get the benefit of the deduction somewhere else. Obviously, they need to be an owner of a pass-through entity in order for us to take the next step and look at what options do we have from the entity level. And then you want to look for, is this pass-through entity having to file in one of these states, one of these 22 states that has passed this legislation and is now allowing us to do this. Now, if I just pause for a second and let you guys kind of have this concept sink in, you can start to see pretty early on in this discussion that this can turn into a very complex planning process, right? And I'm going to kind of go through some more of that in a minute and some of the challenges that you'll potentially face looking at some of these things. I highly, highly recommend that you obviously have these conversations with these clients, but in our firm, this is definitely a billable planning conversation because this can turn into a very lengthy and complex process if the client wants to go through the steps of actually figuring out, is this a benefit to us or not? You could have an entity that is filing in multiple states, and some of the states will allow you to do this and others won't. And now you have to look at, how do we file where we can take advantage of this in the states that will allow us to? How do we file appropriately in the states where we don't have this option available to us? And how do we maximize tax planning for the shareholders and the partners within that space of having these different options? So definitely start to consider, what type of billing are you also going to attach to this, to make sure that as you're moving through, this is clearly some value add, because the right client is going to save a pretty significant amount of tax money if their cap on their individual return is well below what the entity might be liable for in state and local income taxes, but wanting to make sure that as you are taking these projects on, that you're clear that this can get complicated and time consuming. And so absolutely recommend billing for those conversations, those planning conversations. So how do you incorporate this strategy? You do have to look at each pass-through entity individually. So, not just identifying those individual clients that may have experienced a cap last year and were an owner of a pass-through entity, but then going back to the entity and looking at which states is this entity required to file in. Do we have the opportunity to take advantage of this? Are these states in one of the 22 that has passed this legislation? If they're not, I'll just touch on this. We're not going to get into great detail on it, but if the entity is filing in a state that does not allow you this option, you can also look at composite filing. That can get complicated too. You have to give shareholders and partners the option to participate in composite filing or to elect out of it. So if you're working with an entity that has a lot of owners, that can be time consuming as well. But I have found that composite filings in a lot of cases can help to save money for similar reasons, where essentially, different from this particular strategy, the entity would pay non-resident shareholder or partner withholdings that would then kind of cover their tax liability in those cases. But the reason that this particular strategy is so helpful from a tax planning perspective is that the entity itself is going to get the benefit of the deduction. So let's just, again, we'll take the example of our S corporation who has to file in California and New York, who are both entities who have, or state entities who have passed this legislation and allow for the pass-throughs to pay at the entity level for the state taxes related to that pass-through entity. That also means that the pass-through entity itself gets the benefit of the deduction for those payments. So now we're not just benefiting the shareholders or the partners simply by helping them to avoid having their itemized deduction be capped, but you're also creating this strategy where their ordinary income passing through from their K1 is also being reduced by the benefit of this additional deduction. Which again is most likely going to be higher if we're using this strategy correctly than any benefit that they would have received on their personal income tax return. So some of the challenges that we've faced with this, other than it obviously being a very complex planning process, going through and trying to figure out who is the ideal fit for this, is we've had rising issues, and probably most of you have experienced this too, but we've had rising issues with working with state departments of revenue. So the state departments are very understaffed, still similar to the IRS. Whenever you're changing how you're filing something, that can obviously create a situation where there's questions or the state receives a return that it's not necessarily expecting as compared to last year. There's a lot of situations where we see automatic generation of notices where really another department would have had the information to resolve this, but a notice is generated automatically by a computer and just mailed out to the client. So most of you have probably experienced similar issues, and you know exactly, what I'm talking about and where we could kind of run into trouble with some of this stuff. So you want to just be prepared and understand, and also probably have a conversation to prepare your clients that anytime we're making an election to change how we filed as compared to how we filed in the past, there's always the possibility that notices could pop up. And we want to make sure that we have the documentation ready to respond to those notices, not just to make your life easier, but also to reduce the stress on the client. So whenever I have a situation with clients where I think there's a possibility that, either us changing something or this is something new, we could potentially end up with a notice in this situation, I always just let them know ahead of time. You may receive a notice related to this. If you do, don't worry, just pass it right on to us. Let us know when you have it, and we'll make sure that we address it accordingly. Things that have helped us to just really be more efficient in terms of our response, because we have seen more notices in the last year than previous years. Again, a lot of this is just cross-department with both the IRS and the state departments, where a notice is being automatically generated from one department, but the information to clear the notice is being received by another and just hasn't been processed into the system yet. Is just make sure that you're keeping really detailed documentation, copies of checks, payments, etc. So a couple of things to keep in mind when you're utilizing this strategy in particular is that these payments, the state tax payments, if they're making the election to have them be paid and deducted at the entity level, you want to prepare your client to cut those checks or make ACH payments to the states from the entity's business account. So that is going to be a change of how they filed in the past, where shareholders and partners might be used to having to write out all of those checks themselves at the time of personal filing. You want to make sure that you're giving them a heads up that these bills are going to be due at the entity level. That is also most likely going to be a difference in cash flow for them, where the entity wasn't necessarily previously paying for these expenses. Now they would be. So make sure that we're just being forthcoming about that as part of the strategy, that, hey, this is going to shift the timing of these payments, how much is coming out of the entity bank account. So just be prepared for that as well. And then because I did touch on the composite returns, be very careful with those as well. Again, it's completely separate from the states that have enacted the option for this pass-through tax to be paid at the entity level. Composite returns, again, would be where the entity is essentially paying some of the state taxes on the non-resident shareholders portion. So in other words, if I take my example of S Corp, again, having to file in California and New York, maybe I'm a shareholder that lives in New York, but because I own part of this entity, I have to now file in California. The entity can pay non-resident shareholder withholding on my behalf. We've seen a lot of issues with the state departments not matching those payments of the non-resident shareholder payment to a non-resident shareholder's individual income tax return at the time of filing. So we've definitely seen an uptick in notices on those. Again, it seems to just be payment is processed by one department, return is processed by another, and the timing of when they're processing is not matching each other. So just really want to reiterate for you that this is a complex planning process. It can definitely generate some questions and notices, because most often the clients that benefit the most from this are also having to file in multiple states. So the more states you have to deal with, the more opportunity you have for something to go awry. And just making sure that at the time of preparing these returns, that you're keeping all of those copies of checks and ACH payments and things like that will help you later on if you do need to respond to those notices, to just do it a little bit more efficiently, because you'll have everything available to you. Another thing to just keep in mind, in most cases with most of these states, if the entity is going to use this strategy in order to maximize their tax deductions, there is an election that would need to be filed to actually tell the state we are opting into this. So it's not automatic opt-in in every single state. I think there's only one of the 22 states that actually requires it now, but everything else is optional, meaning your you're most likely going to have some extra forms that need to be prepared to opt in and let the state know, hey, this is what we're going to be choosing to do. So just be aware of that as well. As you go through your planning process, like I said earlier, you're going to want to identify the states that each one of these pass-through entities is filing in, identify whether or not these rules have been passed for this state and you can take advantage of this strategy, and then look at how do I take advantage of this strategy? Is there a form that this entity needs to file in order for us to make sure that we're opting into using this methodology to save some money? So I'll pause for just a second. That was a lot of pretty technical information. And I will just, if you guys have any questions at all, I'll give you just a minute to pop those into the Q&A box and see if I can get anything answered for you. And then I'll just follow up with some action steps that you can take away with for today to go back and start working on all of this. So if you have any questions that I haven't answered for you and you want to go ahead and pop those into the Q&A, feel free. I'll give you guys about 10 seconds just so that we make sure that we keep moving along. And if I'm not able to answer your question, I also popped my contact information into the chat, and it's also in the slide deck, which will be sent out as well. So if you think of something after the fact that I wasn't able to answer for you, please feel free to reach out and I'll be happy to answer those questions. Okay, give it about 5 more seconds. I don't see any questions coming in. Okay, perfect. So next steps for you to take away from today, I would go through and I would create a list of clients that you think may be impacted by this. So you could do this a couple of different ways. Again, you can go back and you can start with a list of all of your individual clients who may have met that $10,000 cap on Schedule A when their personal return was filed last year. You can also go through and you can look from the perspective of how many pass-through returns do we prepare that have, I mean, even one state in some cases could be significant, or especially the ones where they have multi-state filing requirements. That's an opportunity for even more savings in a lot of cases. So starting from the perspective of how many pass-through entities do we prepare that might have an opportunity to take advantage of this strategy, and are they filing in states that allow us to? So create that list, and then you have a list to go off of who are the clients that we're going to approach and say, hey, we want to look at this tax planning strategy with you. We think that we can save the shareholders of partners of this organization some money on their personal tax returns. Is this a tax planning conversation that you would like to have with us, and we can provide some added value to you? And then of course I said assess whether or not those states are going to be able to actually give you the benefit of this strategy. So my contact information is right here. I have this beautiful QR code. Thank you to my incredible marketing team. You can scan that, and that will also take you right to the TDT website, and you can find my contact information on there as well. So if you think of any questions after the fact, please feel free to reach out to me. I'm always happy to answer questions for you. But this is definitely a strategy that is going to start popping up more and more with these closely held businesses, these pass-through entities that are going to allow them to really look at how do we save these individual shareholders and partners some money. So with that, I will stop sharing my screen. And if you have any last minute questions, feel free to pop them in.
I am going to throw up one poll question. It's actually about Christine, I don't know if you've even seen the Future Forward summits that we've hosted with Insightful Accountant. We're doing basically 3 a year, and we have one coming up November 30th and December 1st. And it's basically kind of planning for 2023, as well as kind of 2 focuses: planning for 2023 and then niching your practice. Nice. And so I'm just throwing this poll up there. If anybody would like some more information on it, just say yes, and we'll send it over to you. And of course, it'll also be on the websites as well and be promoted there. But it's free up to 8. I think we're going to have 8 sessions over 2 days, kind of runs from 10:30 till 3:30, I believe it is, on the 30th and December the 1st. 8 CPE credits possible. if you sit through all of them. So, and it's free. You don't have to sit through all of them. Pick and choose what you want to sit through. And there you go. Christine, certainly appreciate it. Actually, one question I had, but I think you kind of answered it on your last slide. And again, I'm not a tax guy. If you were going, let's say I've got a book of business, I have 100 clients. How do I really narrow that down to find the 10 or 15, that it makes the most sense for me to take this approach with?
Yeah, great question, because a lot of practices are in that boat. And this is a really, like I said, it's a time-consuming strategy to take a look at. You kind of have some multi-layers that you have to go through to make sure that these are clients that are actually going to benefit from this. So my best recommendation is to look at just your pass-through entities that have a multi-state filing requirement to start with. You can always go down to your pass-through entities that have a single state filing requirement afterwards. But if you really want to narrow it down to, hey, how do I start to roll this out with the ones that are probably going to benefit from the most at the beginning, that's where I would start, is any pass-through entity that has has a multi-state tax filing.
Okay, great.
And then I did just get one question. I promised I would do this. And so here it is about the link that lists the states. So I'm going to pop that in the chat too. You can find this. You can find this in a couple different places, but just so that you guys have at least one resource that lists the states that have passed this legislation, so you have a list that you can go off of, that will help you as well, because obviously we're looking for pass-through entities that not just have a multi-state filing requirement, but hopefully all of the states that they're required to file in will fall into this bucket and they can take advantage of it across the board.
Gotcha. All right, perfect. Well, thank you so much. Appreciate your time. And you didn't tell everybody, you told me you're actually off this week. So thanks for taking a break from, I guess, probably not sunning up in Maine.
It's sunny, but it's cold. So there's definitely, there's definitely no laying around on the beach going on right now. But yes, definitely relaxing a little bit after the October deadline.
All right. Well, I won't keep you any longer. Thank you so much. Appreciate it. And I'm sure we will talk very soon. Thanks, everyone.
Sounds good. Thank you, everybody.